Hello my fellow freedom builders and welcome back to the channel. Today we are going to look at some buying opportunities in, as I said, in the middle of a market crash. Well, the market is not really crashing anymore, not for the last couple of days anyway, but we have been in the middle of a market crash, and the big debate is right now, is the crash over, or have we started a new upturn in the market, or is this just what they call a bear trap, where people are lured into the market and then we get a sell-off more? That is hard to say, really. I am of the conviction myself that I'm not sure that all the bad things that are coming in the future month that we have seen that priced into the market, but that is just my personal opinion and experience. And as you do know, if you have followed my videos for a while, let's just see here, I am tracking how the number of deaths in United States is developing. And I know this can sound a bit morbid or cynical, but as I have seen, when the numbers are growing and growing and growing, at some point there will be a lot of political pressure on leadership in United States to shut states down or the entire country down. That may be not happening, but if the number gets big enough, if we all of a sudden see many thousand deaths per day, then I think that something will come. And we can see as soon as Trump is mentioning some sort of shutdown, we can see the reaction in the market in a negative direction. So this is not because I really fancy sitting looking at number of dead people, absolutely not, but it tells me something about when will there be political pressure in United States to shut the economy more down than it already is. And I have a feeling that we can see that in the stock market. However, that doesn't mean that we shouldn't be looking at some buying opportunities, because if you are a long-term investor, there might be some good opportunities right now, or at least in the coming times, even though that we might see a downturn more of 10 or 15 or 20%. I've seen someone saying 80% more down. I think that is not likely. So let's start looking for some of the good candidates so that we can be ready. And maybe even if you have some money ready now and you're saying to yourself that you only need this money in 10 years or 15 years or 25 years, well, then it might be a good idea to start buying, maybe not tomorrow, but at least soon, now that the prices are low. So what I have done here is that in the fast graphs software, I have made a little screener, and it can be done in a ton of different ways. But what I am looking for is good, solid companies. So I have chosen companies with credit ratings from A- and up. That makes sure that I'm only getting quite solid, stable companies. I know that the credit ratings can be off, but as you can see, I can choose down to D or even below. So I'm choosing from A- and up, which is down here, but from A- and better. So that leaves me with a lot of good candidates that I can look through. Then I'm only looking at United States and normal shares. I'm looking at PE ratios between 5 and 20. That is kind of a normal range. We could choose a bit less and a bit more here, but that was just to narrow it down. I am looking at earnings per share yield of 7% and up. That makes sure that I am almost every time getting stocks where the stock price have run less fast than the earnings. I'll show that in a second, but if you know the fast graph software, we are looking for stocks where the stock price is lagging a bit behind, where the earnings are really growing nicely and the stock price has dropped. So I'm looking for some at least 3% and up in the free cash flow yield. Here I'm looking for market caps from $5 billion and above, $5 billion. And yeah, that was on this page. And on the historic side, I'm looking for earnings per share growth and growth in free cash flow of at least 5% over the last 3 years. And on the estimations or the estimates here, I'm looking for at least an earnings per share growth of 3% per year. However, you should notice that in the market environment we are in right now, these estimates are really on shaky ground. I have seen several companies right now, we saw Ford the other day, that actually pulled back their guidance for 2020 because they said the entire foundation it was made on was ripped away underneath them. And they also suspended the entire dividend program for the year because they said we might actually need a lot of extra liquidity, and therefore I think it is very, very good that companies are thinking ahead. Well, Ford might have considered starting a bit before this, but I think it is great with companies thinking ahead, saying we might actually need some liquidity later on, so why pay all this liquidity out now to the shareholders if it means that we will need a bailout later. So there's a lot of discussion right now if the companies that are going to need bailout from the US government, if they can run buyback programs or dividend programs. And that is kind of a political, personal opinion. But honestly, if you ask me, I would say, why should the company give bailout money to a company if that means they just send it back to the shareholders? In my mind, a bailout money should be used to strengthen the companies. And what we have seen, and this is a bit off topic, but what we have seen the later years is that for instance, in some of the airline companies, they have spent 96% of their free cash flow over the last 5 or 10 years to pay back in buyback programs and dividend programs. So they have not used the time very well, I think. The last 10 years of good times, they could have spent that time building up some solidity in the company, but they haven't. They have simply wasted the time away. We saw that from the tax reform made in, was it 2017, I think it was, we could see that more than 80% of the money that the companies actually saved from this tax reform were spent at stock buyback programs, which of course is great for the shareholders, but it is not really something that if you are a well educated CEO, you should know that you should use the time you have in good times to make a buffer, to bolster your company so you can withstand some bad times as well. And a lot of companies, that is not just in the United States but all over the world, a lot of companies have simply squandered this opportunity to build a more solid foundation, and now they are in deep trouble. However, let's take a look at some of the companies. I think there are some good candidates among them. So with these screening criteria, I didn't, but the screener came up with 26 different companies. And I'm not going to go through 26 companies. Let's just see how far this takes us. But I guess we can have a look at 5 or 7 today, and then I'll make new videos in the next couple of days with more quality companies that have some potential. If you have been following my videos and seen the videos from the playlist with Learn My Strategy, you also know that I'm not personally buying when the stock is still dropping. I have some criteria that I want to see fulfilled about the stock going up faster than the overall market, and I have some quality measures I want to be fulfilled. But the stocks we are having a look at today, I think except 1 or 2, they are actually fulfilling all the criteria I need in my strategy. So that is great. Let's have a look at them. First of all, we have the AppV here. AppV is a stock that I have been doing analysis on before, and I was actually very fond of the company, but also said that it might not be the time to buy it. I actually bought a little portion of it. When was it? I think it was here was it just before New Year? I actually can't recall it. That one is a bit down now, and this is for my very, very long-term portfolio. I have some money in US dollars where I am investing a bit for the very long run, 10, 15, 20 years. So I bought a bit up here in the AppV. And as you can see, right now we're looking at adjusted operating earnings here. And you can see that the orange line here is the earnings, and the blue line is the PE ratio. So this is the historical average of the two, of the growth and the PE. And as you can see, the price has, the black line here is the stock price, and that has oscillated nicely around these earnings and PE numbers here. They have been paying, they have been raising their dividends for a while, and right now they are down in what we call cheap territory or value territory. That doesn't mean you should always buy. We need to do some more quality checks. But as you can see right now, if we should up and get up and meet this fair value or fair price here, there is some very good. Let's just have a look here. If it should get up here in a couple of years, we can actually see, including the expected dividends, 59% on annual return here. We might not get as much, we might only get up here, but what I do like when I'm looking at stocks is I like to catch them in an area where there is a lot of potential, so that even though we can just have a quick look at the forecasting mode here. Yes, even though that we might not get up to the middle ground here, even though that we are quote unquote only getting up to let's see up here at a PE of 10.5. Right now we are down at, just a second, it's a bit weird this graph, but right now we are down at a PE of 7.5 for a company as good as AbbVie. That is quite amazing. Should we get up over the next couple of years to a PE of 10.5, well, then we can see a 31% growth. And I'll not go very much in depth with the different sectors and different companies today. I'll just give you some inspiration so you can start to dig a bit further yourself into the company. But if we have a quick glance here at the AppV here in Stockopedia, you can see that they have it has a quality rating of 95, meaning that the way they measure quality, the AppV is in the top 5% area here, so it is better than 95% of the other companies that it is compared with. Value is actually fair. Momentum is very good. This is not just momentum and price, but also in earnings expectations and so on, so on. Stock rank, at 98, so it is better than 98% of all of the other companies. So this is something that makes me want to look a bit further into it. The PEG ratio, as you can see, the PE ratio is great, but when you take the PE ratio and divide it by the expected future growth in earnings, we get a very low number here. I like that to be below 2, so this is very good. We have some good dividend yield, and of course the dividend yield we need to double check in a second. You can see the earnings per share is growing steadily. That's very nice. What I do like to see is growing free cash flow as well. Very good. The dividend yield is 6.66 estimated here in 2020. They are a bit low on the dividend cover. They are estimating that to go up, but as I said in the beginning, right now in the current market environment, I expect a lot of companies being put under pressure on liquidity. They really need some money in the bank, and I suspect that a company like AbbVie, being as low as they are here, spending pretty much all of their earnings per share on dividends, I could suspect that this dividend was not very certain. In my opinion, that doesn't matter too much. I would much rather like a high quality company that spend a year or two not paying as much out in dividend and using that company to stabilize their base. And in this environment, there might be some of their competitors that are pretty much going under. And if they have enough liquidity, if they have enough money in the bank, they can actually buy some very cheap competitors up. So in that case, I actually don't want the dividend in my hand right now. I would much rather that a very good management in the company took care of that money and made the company grow even more. That's just my opinion. There can be a million different opinions to that. The debt is pretty stable, and we can see the interest coverage is not huge but fair, meaning they can pretty easily pay their interest with the money they make from earnings per share. So absolutely, AppV is a stock I could think of buying a bit more of. All right, let's have a look at the next one at the list, Allstate. Let's just have a look at the graph here. Coming up. Here you see it. And what we're seeing here, let's just have a look at a 12-year, meaning 10-year back, and then 2 years, 3 years into the future. What we can see here is a bit more unstable growth over time. But in the last couple of years, 2-3 years, they have been growing very nicely. 43%, 16%. 29%, but then there are some estimates that are a bit flat here, and you could say that that would be a reason for me to stay away. And of course, with the entire situation right now, and Allstate might be a company that is a bit will be a bit under pressure here in the next year or so. You might argue that this one might actually turn negative, and I agree. A company, especially in the current market situation, with very low expectations into future earnings, and us knowing that that can easily be lowered by several percentage points, then this might not be the one I would be looking for right away. But if it should move up here in this area, we can see that there are actually some nice return for us. But let's just have a look at the Allstate in here, in the Stockopedia. When we look at the Allstate here, we can see that the quality is actually below the 70 that I like it to be at least. So it is not perfect, but 81 here, 79 in the value, and the stock rank here 95. That's actually quite fair. My take at the value is that the value is when they calculate the value, of course, they are looking at the former numbers, the historic numbers, and at the estimates. And right now, all you can use is really the historic numbers, because the estimates are going to be crushed in many companies, in many cases. So I'm not looking too much at the value. I don't think that really holds up here. What we see here is price to sale low. It is, yeah. Let's just dive in here. It is a bit whipsaw earnings per share here. That's not really the type of graph that I like. Too many negatives here where the earnings per share is actually dropping. We do have a fair growth in cash flow and free cash flow. They are paying out some dividend, not much, 2.2% is fair, but they have a very nice dividend cover, meaning that even though they would lower their dividend payments, I think that the dividend here around 2% would be fairly safe here at the Allstate. I'm not sure you know what the Allstate do, but it is an insurance in the insurance sector. You can see that the analysts are saying a buy here, and you could also see that their interest coverage, that might be because I'm not sure why they don't have an interest coverage here, but this is not my main candidate. I would say there are too many, both in the growth here. Let me just find it here. Here, the growth that is a bit weak and could easily turn negative. And what I do like is some very good estimates for growth. Also, of course, based in some solid analysis or work here. but I do like to see some solid growth, so that even though it tips off a bit, bends a bit down, then we still have a lot of movement up towards a fair value. All right, let's have a look at a couple more. Another candidate here that I actually own a small portion of, and that I do love a lot, is Applied Materials. And if we take a look at the Applied Materials here, let's have a look. Applied Materials had a rough year here with minus 32% in the adjusted earnings. But we can see that it has been following the line here pretty steadily. And down here, when we got a good buy signal, a good long signal down here, there was some very good potential at making up to 46% in a very short while here. But right now we are moving into cheap territory, and nobody knows if we should be at 45 or we should be down at 35. But the estimates, if they hold up, and let's see what the next quarterly numbers are saying, but if they seem to be holding up, then we have some very good moving potential upwards here. And if we look at the AMAT in here at Stockopedia, Applied Materials, here you can see it is very solid, 81, 89 and 87 here, a good low PEG ratio. Let's just have a look, a quick glance at the numbers. You can see the return on capital, equity and operating margins are very good. We can see the earnings per share normalized, dropped a bit in 19, but the estimates are quite good. We can see that the cash flow is quite stable. They're paying out just below 2% in dividend, but as you can see, a nice dividend cover, giving some room for cutting the dividends if they need some cash. Net debt is not crazy high, and an interest coverage that is on a very good side here, 35%. Analysts are saying a buy or close to a strong buy. So, well, as you can see, if you didn't know already, manufacturing equipment, service and software. And if you are looking at a company, at least in these days, where you're not sure what they're making, I would suggest that you don't just look at the numbers. What I normally do is a lot of what you call quantitative fundamental analysis, meaning that I'm looking a lot of the numbers. Are they growing in the right direction? Are the estimates right? What does your graph tell me? And so on. But right now, I think it is important to do a bit of due diligence, a bit of qualitative fundamental analysis, where you are actually considering, is this a sector that might be a good sector to be in? Let's say, for instance, that one of the stocks that came up here was in a cruise line or an airline or some sort of company in one of the sectors where you're saying, I haven't got a clue if this will tank completely and go under, or if it will survive. It could also be in some of the smaller oil companies that are getting hit right now by the oil price crisis, with Saudi Arabia and Russia pushing the prices right now. So the entire shale oil industry is under tremendous pressure. So you could easily find a company where you said, it is showing good value, at least when looking at the historical numbers. But when you take a look at what sector is it in, you might figure, well, this is not a risk I'm willing to take, because this sector is simply so uncertain and unstable in the future that I haven't got a clue what to do with it. Of course, you can consider it some sort of a lottery ticket and saying, well, it could go to zero, but it could also make a 10x. Yeah, well, it could. That's just not the way I invest. I do like good, solid, strong trends. Also meaning that there will be a lot of opportunities that I could take these days that I might not be taking, because that some of the numbers that will come out now is simply destroying the good trend of good numbers from the companies. All right. I hope that makes some sort of sense. Then we have AMP here, Ameriprise Financials, and let's have a look at it. All right, here we are. We can see good solid trend in earnings. A A little drawdown here, but nothing that we should really notice. And then the estimates are great. Right now it is really tanking. It has gone down from 165 to 103. So pretty much been following the market. Dividends have been growing steadily. So right now, if we figure that this is a good company, that this is a very good opportunity with high value and good future potential, then there is a very large room to the upside here for making a lot of percentages quite quickly if it should move up here. We don't know if it will, and therefore I could just say that I could easily look here at some of the other, the EBITDA or the operating cash flow, that might give a bit of a different picture. But right now, just in the quick go through here, I am looking at adjusted earnings. And if we are looking in here at the Stockopedia, you can see that it is not really fulfilling any of my criteria here. It is a 38, 57 and a 57. That is definitely in the low end. And if we look down here, we might get a clue as to how or why. The earnings per share is quite good. We can see that the cash flow a bit bumpy, but fair enough. Free cash flow also. Dividend yield is 3.7. So right now in the numbers, there's actually not really anything that really turns on the alert lamp here with me. But let's just see the net debt. Yeah, interest coverage. I would have to go a bit more into the numbers to see why they think the quality of the earnings and the numbers are as bad as they are. So you should not always take these as just the holy grail of numbers. It is important to know how they are calculated. And if you are a member on Stockopedia, I can drop a link below here. That'll give you a 25% discount. But if you are a member in here, you can just press the different every time something is made as a hyperlink. I'm not sure it's called that anymore. It was that in the old days. You can see a definition of quality rank as some of the ways it is calculated. So I often use it as a rule of thumb above 70 and some guidelines. But I also like to see in here, down here, why it is not really performing. It could be the estimated earnings per share growth here at 6.7. You could also see return on capital will definitely be one of them. 1.6% is not very much, but actually the numbers otherwise look quite okay. So I might put it on the list just to be one of the candidates, but it would not be one of the first that I would buy. Definitely not. All right, let me just give you one more and then we can continue the list tomorrow. Anthem here. Let's have a look at the graph. All right, here we have Anthem, and it is just by looking at the graph, it actually looks quite well. It has been oscillating around the PE and earnings line here, so that is quite well. We can see that every time it has been in the cheap territory here, and we have been willing to hold it for a period of time. We have been able to make some very good returns. Now I'm picking up a bottom to a top, and we would of course never get in right at the bottom or right at the top, but let's just say fairly here, we would have been able to make some very good returns. So it is a stock where we can see from the history that it actually tends to give us some good returns if we follow these rules. They have been growing very nicely. The dividend is not huge, but I do like the difference between the earnings here and the dividend line, because in some companies you can actually see that the dividends are tipping up above the earnings line, and that means they're actually spending more on dividends than they are making, and that is not one of my favorite criteria at all. So right now it is in an area where we could look to buy, but we would have to do some more research. And of course, some of the research we would be making, let's just see here, Anthem coming here, and you can see the numbers are fairly okay. 62 in quality, not the 70 we want, but 77 here, 78 here, that seems okay. The numbers are actually fairly well. The earnings per share growth in the estimates, or the 12-month forecast rolling here, Dividend yields 1.7% approximately. That is okay. Return on capital, return on equity, nothing really here. And when we look at the numbers, you can see the earnings per share growing nicely. Free cash flow a bit bumpy here, but okay. We can see that the dividend cover is quite fair, is almost 6, and they are estimating it to be even bigger. But as I said before, these 3.2, 3.7, almost 4, it's not something I would count on in these stressful times. And if you don't know the company, it is a company that is doing this what we call network-based managed care plans to large and small employers. I'm not an expert on Anthem, but just this with individual Medicaid and Medicare markets, care plans and so on, what I would carefully consider before entering into a company like this is I would have to do a lot of due diligence as to how many liabilities they have into this. Right now this illness is spreading all over the world. Let's hope that they find some cure for it. But let's say that this really runs wild over the next 3 months or 6 months before they can put a stop to it. Then I would have to do a lot more research into a company doing business in this segment, because some of the companies here are insurance based, and they actually are supposed to pay up for some of the many treatments on the hospitals in the upcoming times here. So as I said, I'm not an expert on this and I would have to dive deeper, but it's just to give you an example that I'm just trying to evaluate. Is this a stable sector? Is it somewhere they might be actually making money on the crisis, but at least I am looking for something that is quite stable. It could be the consumer staples. It could be some healthcare that delivers a product that people really need to keep buying, even though there is a financial crisis of some sort. And yeah, so this one, I would definitely have to dig deeper into this. There's probably some of you out there knowing all about this company, but I would have to dig a lot deeper. So these were the first companies on my list: the AbbVie, the Allstate, which is also an insurance. There's the Applied Materials, the Ameriprise, which is this, I'm not sure I mentioned that, but this financial advisory service. And then the Anthem. And what I do like here is I do like the AbbVie, actually also the Applied Materials. The other three here is I'm not sure about them. But I will slowly grow this list over the next days, making 5 or 7 stocks each and every day. In the upcoming videos, I won't have to explain all about the screener here, so we can just move on down the list of the stocks. So watch out for videos in the next days. I'll try to get to make one every single day, but then again, I am working at home. We are also under shutdown and I have the kids at home, so there might be a bit too much noise sometimes to make new videos. But I will see if I can make one per day about the opportunities here. So let's see if we can find some very good, solid, fast growing stocks for you out there you can put into your portfolio whenever this mess is over. If you haven't done already, remember to subscribe to the channel, hit the like button and all that, so you can see more of our videos when they come out 2 to 4 times every single week. Alright, take care of yourself, take care of your money out there. Talk to you again soon. Bye for now.